Welcome back after the break. I'm John Garrett. I'm the host for today's session of the Future or the Tax Forward conference. My apologies. So now we have a panel coming up, a tax reform that could drive recovery. We have 5 people that are going to be part of this panel. It's going to be pretty interesting to see where the conversation goes. So on this panel is going to be Tad Fowler, Senior Vice President, Treasury, Assistant Treasurer, Global Tax Operations with Procter & Gamble, Tony Nitti, Senior Contributor for Taxes for Forbes, and also a RubinBrown partner. We have Laurence Kotlikoff, best-selling author and speaker, Professor of Economics at Boston University, President of Economics and Security Planning, Inc. And then the moderator, I believe, is Scott Peterson, Vice President of U.S. Tax Policy and Government Relations at Avalara. There's a lot of brains going on in this group, so I'm going to politely duck out and let you guys take it from here. So thank you.
Thank you, John. Appreciate it. And there is a lot of brains going on here, so I'm going to try to keep my mouth shut as much as I can so everybody else knows who the brains are. We're talking about tax policy reform, and all those words mean something different to everybody. And there's no right answer or no wrong answer. The only right answer in tax policy is the guaranteed rate to not collect any taxes is to have a 0 rate and a 100% rate. Otherwise, everything in the middle gets you some of the taxes collected. So today we're going to start off with Tony talking about where we are, and Tad's going to jump in and talk about how this affects a very large company, and Larry is going to talk about the economics behind the stuff that happened and the stuff that could happen. And I'm going to try, like I said, to keep my mouth shut as much as I can so the brains here can tell us what they really need to know. Thank you.
Well, thanks so much, Scott. Hello to everybody. So yeah, as you may have heard, we've got an election coming up, about 10 days. And it's funny, you go back about a year and there was a decent chance that tax policy, would have been the biggest talking point leading up to this election. Obviously, enough has changed in the last year to push tax policy off the front page, but it's still going to be a significant aspect of the upcoming election. And what we are potentially looking at here, depending on the way things shake out on November 3rd, right? You could argue, hey, Tony, there's always going to be consequences of an election from a tax policy perspective. But what we're looking at here, these are not your traditional, subtle tweaks that might be made to the tax law. We are looking at potentially monumental shifts, particularly in the way we tax kind of the wealthiest 1 to 5%, the highest earning 1 to 5% of individuals and corporations. And so I just wanted to give a really brief history of kind of how we got to this point where we could be facing as big a shifts as we're talking about. And the reason tax reform would have been really one of the highlights leading up to the election had we not had a global pandemic and 60-style civil rights movements and a dip in the economy in the last 9 months is because really the signature legislation of President Trump's first term was the passage of the Tax Cuts and Jobs Act on December 22nd, 2017. And just so everybody understands, right, when President Trump won the White House, the stars were aligned for the Republican Party to really, right, enact their vision of the tax law without any input from Democrats. And that's because you had President Trump in the White House and you had Republican control of the Democrat in the Senate, Republican control of the House and the Senate. And so really using what we call this streamlined budget reconciliation process, they could pass a tax bill without a single vote from a Democrat. And if you don't need a Democrat to vote for a bill, then you certainly don't need to invite them to the table to help write the bill. And that's exactly what the Republicans did with the Tax Cuts and Jobs Act, right? And so they got it passed using budget reconciliation. And we had the most comprehensive overhaul of the tax code since 1986. You're probably familiar with the headlining changes, but clearly dropping the corporate rate from 35% to 21% was extremely significant. We dropped the top individual rate from 39.6 to 37. We created, a new 20% pass-through deduction under Section 199 Cap A. We dramatically changed the way we tax international operations of multinational corporations, whether it be through the deemed repatriation or GILTI or BEAT tax. And so we made these significant changes, okay? And what we need to understand here is that two things. Number one, the Tax Cuts and Jobs Act was partly temporary by design, okay? Because all of the individual provisions, for the most part, when the clock strikes midnight on December 31st, 2025, akin to Cinderella's carriage reverting back into a pumpkin, these provisions all kind of disappear and everything goes back to 2017 law. So we have a temporary law to begin with. Then you layer on top of that the fact that really, if you think about it, Tax Cuts and Jobs Act is far more temporary than 2025, because what did I say? Right? It was written and voted for only by Republicans. So if the balance of power shifts, right? If Joe Biden wins the White House and Democrats take back the Senate and they already control the House, do we expect that Democrats would be content to just let the Tax Cuts and Jobs Act be the law of the land? Of course not. They're going to want to put their own stamp on things, right? What kind of stamp might they want to put on things? Well, for that, we have to understand and appreciate two facts about the Tax Cuts and Jobs Act that will never cease to amaze me, because when you first hear them, you say, those two things can't coexist. But the numbers don't lie, right? The Tax Cuts and Jobs Act was a $1.5 trillion tax cut over 10 years. And in 2018, relative to 2017, about 9 out of 10 taxpayers who earn more than $40,000 a year paid less in 2018 than they did in 2017. So 9 out of 10 people got a tax cut from the Tax Cuts and Jobs Act. But amazingly, the highest the Tax Cuts and Jobs Act really ever polled in terms of public popularity was around 38%. And you go, well, how do those two things coexist, right? 9 out of 10 people got a tax cut, but only 4 out of 10 were happy about it. And the reason why that is probably the most true thing you'll ever hear about tax reform, but it's that the only thing that makes people angrier than not getting a tax cut is getting a cut, but believing in their heart of hearts that their richer neighbor got a bigger one. And that is ultimately what has plagued the Tax Cuts and Jobs Act since it was passed is, again, my allegiance is not to the right or the left, it's to the numbers. And the numbers would indicate that in that bill, right, the biggest piece of the pie, the biggest tax cuts went to the richest 1 to 5% and to corporations. And people got upset about that. They felt like it was a giveaway to the rich and to corporations. And certainly Democrats did nothing to play that down. And so as things evolved and we started to get closer to the 2020 election, think about it. If you're a Democratic candidate, right, for president, it doesn't take the master stroke of a genius strategist to figure out what your tax plan should look like. If 6 out of 10 people were angry with the Tax Cuts and Jobs Act because they believed it gave away too much of the benefits to the richest 5% corporations, well, if you devise a tax plan, right, that taxes the heck out of the richest 5% in corporations in order to pay for your plan, the theory is it should be politically popular. And so that's what we saw with Elizabeth Warren and with Kamala Harris and Bernie Sanders, right? Huge targeted tax increases taking aim at the nation's wealthiest in corporations, whether it was a wealth tax or a mark-to-market system on capital gains. And Joe Biden has come in with a much more moderate approach, but it's a very similar approach where he's saying, hey, wait a minute, right? I think that there's an appetite among the public for me, if I win the White House, to raise the tax revenue I need and to do it specifically from the richest 5% in corporations. So when we talk about the future of tax reform, there's a lot at stake, okay? Because if President Trump wins re-election, he hasn't said much about a second term, but his informal proposals, he's included, for example, dropping the capital gains rate from 20% down to 15%. He has floated the idea albeit informally, of eliminating the payroll tax. But every time he does that, the White House kind of quickly backs away and says, nobody's going to be getting rid of the payroll tax. We have the solvency of Social Security to deal with. But aside from those things and kind of a vague middle-class cut, the only thing President Trump has really said is, hey, I'll make it a priority to make permanent those individual cuts that were part of the Tax Cuts and Jobs Act. So that's what we have on one side of the coin, just more cuts effectively. But Joe Biden has come in and said, hey, if I win and if the Democrats take back the Senate and we can do what we want, right, I make no bones that I'm going to raise taxes. In fact, I'm going to raise about $4 trillion in taxes over 10 years, but targeted increases, taking aim at the richest 1% to 5% in corporations. And so when we say the richest 1% to 5%, he has come out and promised and said he would put safeguards in place to ensure that there's no increase for anybody making more than $400,000. No increase for anyone making less than $400,000, sorry. So what would it look like? A return of the top rate from 37% to 39.6%. Doing away with the preferential rate for capital gains and dividends for taxpayers making more than $1 million. So all of a sudden their top rate on capital gains isn't 20 anymore, it's 39.6. And then bringing back the 12.4% Social Security tax on wages over $400,000, right, which could have a significant impact. And then from a business perspective, he has proposed to increase the corporate rate to 28% from 21%, and then to actually step outside the code and impose a minimum tax on large corporations that have significant book profits, right, based on their book profits, because he recognizes that people get upset when they read that XYZ Corporation had $200 million of book profits but paid zero in federal income tax. And so that's kind of his way of working around it. And so you think about what's at stake to sum this all up, right? We have President Trump talking additional cuts. We have former Vice President Joe Biden saying, if I get elected, we're looking at potentially $4 trillion of additional revenue from corporations in the richest 5%. So this is not just your normal election. Hey, depending on who wins, we may see some tweaks in the tax law. We're talking about potentially a huge swing in federal revenue collected from a tax perspective, depending on what happens in 10 days. And some of the provisions that hang in the balance are the ones we'll be talking about today, whether it's 100% expensing or limitation on deduction for interest expenses, or other provisions of the Tax Cuts and Jobs Act that may look very different if Joe Biden wins. And so that's how we got here, and setting the stage for why tax reform may come to dominate our lives over the next year or two. But what we're here to talk about is, what's good tax reform? What could lead to economic growth? Or, right, one of the better questions might be, is tax reform even what we need right now? Or is it just to get a handle on the pandemic? And for that, there's nobody better positioned than to give a view from an economic standpoint and from a practical business standpoint than Laurence and Tad.
So thank you, Tony. That was perfect. I'm married to a partner in a public accounting firm, and we pay every state income tax in the United States. So our federal taxes are obscene, but when those went down, all the other taxes just kind of stayed the same or went up a little bit. And we were one of those people that didn't really get much out of that because we had to deal so much with the states. Tad, on the other hand, P&G is a federal tax-paying behemoth and is significantly impacted by the effect of TCJA here in relationship to what you guys do around the world. So give us a real world perspective on how that conversation started and how it ended up, and whether or not that conversation at the beginning would have been a better deal or a worse deal than what we ended up with.
Sure, you're taking me back, in my former days as a partner. I remember filing in all those 50 states and trying to do credits from one state to another, and there were even some foreign taxes. It seems like I was paying at one point in time or another, and I don't miss those days. It's one of the advantages of being an employee at a big company is I've got a federal return and a state return to file. My life's been much simplified in that regard. But yeah, tax reform took a long time. We were probably working on it for 10 plus years. Okay. And some of those years we were playing defense to keep things that we thought were even probably less competitive than the old system was from happening. And when the time came that we could get on offense, we went on offense and ultimately got to a composition in Congress and the White House that we could actually get something done. And I think actually tax reform was a big step forward in terms of a pro-growth policy, if you will. And I think we were starting to see the benefits of that before the pandemic hit. And if we think about kind of, it was clear to us, particularly with our work on the Hill, that there was a bipartisan understanding that we had a very uncompetitive system. I'm talking about corporate reform here, and I'll touch on individuals in a minute. And the real question, though, is where do you go from having a very uncompetitive system? Where do you go, and how do you pay for it? And I think, and I think that question is going to be the same question we're going to be addressing over the next couple of years. But if you go back pre-tax reform, we had a 35% tax rate. The average in the rest of the world was in the low 20s. And so we were already fairly, from a marginal rate perspective, higher than the rest of the world. We had a worldwide tax system, which basically no industrialized country in the world had, which was very uncompetitive on a long-term basis if you were a U.S. multinational. And so I think tax reform took a step forward on both of those. Certainly the 21% rate. When you include an average state tax rate of 3 or 4%, a U.S. MNC now probably average tax rates are in the 24, 25% arena. We're average with the rest of the world. Okay, we haven't, I don't think, started another race to the bottom, if you will, which is sort of what the 86 Tax Reform Act did when we went from the high 40s down to the low 30s. And the rest of the world followed, but kept going. Okay, and certainly the implementation of a territorial system, I'll call it a hybrid territorial system, at least for us on a very long-term basis, was probably the most important aspect of tax reform, because it allows us to access foreign earnings and reinvest or utilize them in the most advantageous way for the company and its other stakeholders. And there were limits on our ability to do that pre-tax reform. So that was huge in terms of a step forward for competitiveness for U.S. MNCs. I think the piece that is often forgotten is there was a price to pay for that. As Tony mentioned, it was a $1.5 trillion deficit funded package. But the tax cuts resulted in about a $1.8 or $1.9 trillion cost. And to get to 1.5, they had to raise revenue somewhere. And it mostly came from multinationals. It came from the toll charge. It came from limiting interest expense deductions. And it came from the implementation of a minimum tax on foreign earnings. And so there was a price to pay by some taxpayers for the promise of a better pro-growth policy going forward. And I think to the extent that we rush in to kind of change what was done a few years ago, I think we are disadvantaging those companies that paid for getting to a better system. And, if you think about what else it did, I mean, business income in general, tax rates on business income went down even at the pass-through level. And, small and medium enterprises are an important piece of the economic growth engine in the United States. And so, lower rates on business income combined with expensing, combined with lower rates at the corporate level, combined with a territorial system, I think those were all steps in the right direction. And I'd hate to kind of think about reversion of any of those as we think about how to, as we think about tax reform. And one of the questions I know we talked about in our pre-call, and I'd love to get Larry and Tony's view on this, is, what is going to drive tax reform? We knew we were going to be in the debate before 2025 because of the individual tax cut sunsets. But, we sort of thought, at least on the business level or at the corporate level, we had some stability. And certainly as a multinational, one of the things we look for when we make investment decisions, I mean, tax is a cost like any other item of cost in the income statement. but it's not always about where the lower rate is. A lot of it's about predictability, certainty, rule of law, stability. And I think about, non-US companies that want to invest in the United States or have a certain finite amount of dollars to invest, and they look at the US versus maybe other parts of the world. And I think there's a question about the stability of our system, right? How stable and how confident can you be in terms of the economic environment that you're investing in, because taxes are obviously a big piece of that. And so I think we have a lot to gain by having stability. Okay. And I think an immediate debate where we start talking about raising corporate income taxes or changing other aspects for revenue raising, I think creates some risk with undoing a lot of the benefits we saw from tax reform that I think made the US a more competitive place to invest and was an accelerator of growth of our small and medium enterprises. So I think that's kind of one perspective. And as a consumer products company, a healthy economy is extremely important. And, as I do a lot of teaching and instructing at the university level, I like to ask the question, if there's two policies and one requires one allows P&G to pay less taxes than more, but doesn't result in economic growth, or there's another one that results in economic growth, but we got to pay a little bit more, which one do you think we support? And at the end of the day, if paying more taxes results in economic growth, count us in, because that's what's important for us. But I'd like to think there's a correlation there between a pro-growth tax policy and what's good for P&G and other businesses. But it's a complicated issue. Obviously, a lot of different dynamics and considerations that have to be thought through and addressed. But at the end of the day, there's no doubt we're going to be in the dialogue and discussion, and we're going to try to help educate as much as we can about the importance of having a competitive system.
Thank you, Ted. That was great. Larry, I spent 30 years working for politicians, and probably 2,000 state, 3 governors and 2,000 state legislators. There was one economist in that bunch. And I don't know what the heck he was thinking. He one of the most frustrated people to ever serve in the South Dakota legislature, because he said, where's the math? Where's the math? How come you guys don't use any math when you're doing this? Like, where are the economic principles of the studies you're trying to do? So Larry, let's bring some economics into this conversation about federal and state tax policy.
Okay, great. Well, first of all, thanks for having me. And Tax Forward, and great to be with you guys, and everybody in the audience there. So, let me just kind of set the stage here for our situation. We have a long-run fiscal gap in the country that's enormous. So, the Tax Cut and Job Act certainly did some good things, maybe made us more competitive. Certainly, I think lowered our effective marginal tax rates to something that's closer to the average on investing in the U.S. But at the same time, it came at a cost of revenue. And one reason, Tony, that maybe people aren't so excited by the TCJA at a personal level is that the size of the tax cuts was really somewhere between 1 and 2 percentage points, depending on what state you lived in. It wasn't that huge, and it really doesn't. It's not that much bigger for rich people in terms of a percentage, absolute terms, absolutely. But in terms of a percentage hike, it wasn't that much. It's more of a kind of a structural reform. And it is a shame that they didn't bring the Democrats into the discussion, because, actually there was some economic input from people like me and Alan Auerbach, who's a Democrat. I'm an independent. He's a professor at Berkeley. So the original Better Way plan of Paul Ryan was almost identical to Alan's proposal and things we've been talking about for years. And basically our economists think that we should be heading towards consumption taxation. And the one way you can get there in a variety of different ways. Herman Cain had that 999 plan, which was a sales tax, a flat tax, and a value-added tax. These are like 3 consumption taxes that he was proposing. And each of them actually may sound very regressive to Democrats, but to economists, when you look at it, the consumption taxation is actually pretty progressive because it goes after wealth as well as wages. And the reason you can see that is if you think about somebody who's got a lot of money and they're retired and all they're going to do through time is spend money or give it to their kids to spend when they pass away. Well, every time they spend it, they have to pay taxes at the store if it's a retail sales tax. So a consumption tax is also taxing wealth. So one of the things, I'm seeing is that we're kind of talking past each other. This goes back to Scott's point that we don't have economists really in the Congress. No, there's not a single PhD economist in Congress. So we have Democrats not realizing that consumption taxation, and we move somewhat towards that with TCJA, with it, including expensing for equipment. That's a move in some ways towards progressivity. It's there's a failure to understand the need for revenues. There's a failure to understand that if we keep investment out of our country, that's going to hurt workers in terms of their wages. In some ways, the Democrats should have been the ones who were pushing the hardest for corporate tax reform because there's a good argument that, at least I view this to be the case, that workers actually pay the corporate tax, because if you raise the corporate tax in a way that keeps investment out of the country, you're going to have workers having less capital to work with, machine equipment, plants, and therefore their wages will be lower, they'll be less productive. So the discussion, so I'm saying we need to keep the incentives to invest in the US correct. We need to get the right amount of revenue through time. We don't have that by a long shot. We need to make sure that people have incentives to work. The Biden plan is going to dramatically raise the marginal taxation of the super rich. Whether that's going to leave them to leave the country or to stop working, I don't know, but it's going to put them into 60 to 70% tax brackets at the margin. But of course, we have a lot of poor people who are in those kind of tax brackets too, because they earn money, they lose welfare, different kinds of benefits. So we have to we still have lots of structural problems. We have a long-term fiscal gap problem. We have Biden's plan is going to do some good things in terms of trying to shore up Social Security, raise revenues, but it's got this concern about marginal taxation of the rich. Maybe some people don't care about that. And on the corporate side, raising the tax rate in the context of having 100% expensing may not really raise the effective marginal. If you had 100% expensing on all investment in the US and you raise the corporate tax rate, it would really be effectively a tax on wealth, because you get this write-off and then you have to pay, you get the write-off at a higher rate, that's the expensing, and then you have to pay taxes on the profit stream on any new investment at a higher rate. And in present value, the two things cancel at the margin. So it depends on how the Democrats put this into place. If they raise the rate and eliminate the expensing and go to some, let's say economic depreciation, we will have a higher effective marginal tax rate and be less competitive. If they just raise the rate and let's say expanded expensing to all of investment, that's actually what economists would think would be an efficient way to get more revenue, make things more progressive or fair, because it would be in effect an implicit tax on wealth. The value of old capital would fall in the marketplace relative to new capital because it doesn't come with the expensing. If you buy an old machine, there'd be a recapture tax if you try to expense it. So this is a lot, more involved. I see us making some progress in TCJA, but we have some big problems, and we definitely need more fundamental tax reform, both to get the revenue stream, to get the incentives to work at something reasonable. And I'll just say this last thing, which is, were I president, I would try and implement a progressive cash flow consumption tax, eliminate the corporate tax, eliminate the payroll tax, or at least make the payroll tax more progressive than we now have. And and tax people's consumption worldwide at a progressive rate. And that would be, I think, what most economists in public finance would go for. So we do have a lot of room for fiscal improvement, and maybe the Democrats will be reasonable if they get into office. And I don't know, on Trump, if he's reelected, I don't see him necessarily engaging in anything fundamental with respect to fixing Social Security, with respect to fixing, the long-term fiscal gap, with respect to having something, TCJA just was not that big a deal in terms of, apart from the corporate side, in terms of getting people into lower marginal tax brackets for working. Anyway, let me stop there.
Thank you. I'm always fascinated to listen to conversations about the marginal tax rate diminishing someone's ability to interest in working. And maybe it's because I grew up very poor. If I can keep 5 cents, I'm going to continue working. If I can keep 7 cents, I'm going to continue working. I'm not going to stop working when I get to keep until I get to keep zero. So Tony, in your perspective, and in the firm's perspective, what didn't work in the TCJA? What just fell flat?
Well, I don't know that there's anything we would point to that necessarily said, fell flat. I think the concern arising from the things we liked in the TCJA were the fact that our kind of most favored provisions were temporary, right? So listen, we can't have a conversation, we've already kind of introduced it, but we can't have a conversation about tax reform to drive economic growth without kind of addressing everybody's favorite way to do that through tax reform, and that's 100% expensing. And so with the TCJA, right, we got 100% expensing, not in full form. We didn't get it on structures, but we did get it on assets with a life of 20 years or less, and we got it on used assets, which again, we certainly were in favor of. The problem is, right, like so many things we're dealing with right now in our unstable code, it's temporary. So by 2023, right, 100% expensing is going to be down to 80, and then 60, and then 40, and so on and so forth. And so really what my challenges, what I've seen with clients really echo kind of Tad's sentiments, which is like, look, tax cuts are great, a lower rate is great, but man, would it be really nice if we just had an idea where the law is going to be in 2, 3, 5, 6 years, and I know you can say you never really know for certain, of course, because political winds change, but having so many things that we like about the Tax Cuts and Jobs Act maybe not be permanent aspects is certainly troubling. And it's not just 100% expensing, it's starting 2023 R&D, which we certainly love in terms of creating an incentive for growth, being able to take a research and development credit and certainly immediate expensing for R&D costs. Suddenly those costs are going to have to be capitalized and amortized over 5 years starting in 2023. And so there was nothing in the Tax Cuts and Jobs Act that we necessarily said, it fell flat. Like, look, in my line of work, I think we would all have really preferred that 199 Cap A, the 20% pass-through deduction, never made it into the law. Not really, again, for the same reason that Larry might as an economist, but just because it's such an unwieldy provision that it's so difficult for clients to understand, and it picks winners and losers by industry, right? Certain industries, you don't get the deduction if you're above a certain threshold. And we always kind of say that good tax policy doesn't do that. But 199 Cap A, again, not to say it fell flat in terms of encouraging growth, it's just a bit of a mess of a provision. But just to sum it up, I think the real issue with the Tax Cuts and Jobs Act, from my perspective, is just, again, how temporary it is, and the fact that we've all known that it was temporary not only by design, but because of the nature of the way the bill was passed. And we all knew we were building towards this 2020 election and the potential that we're going to have to now spend the next 2-3 years of our lives learning about the Budget Reconciliation Act of 2021.
So Tad, how does temporary affect the business's perspective on what they're going to spend money on?
Well, I think, we've hit on it I mean, first off, both Tony and Larry have alluded to it. I mean, it was not the prettiest process to get the TCJA done. And I think had it been able to get done on a bipartisan basis, we probably have a little more stability in the system. It's probably not a lot different than what happened with the ACA. And so I think that's the concern. I think from our perspective, what's important is, I mean, obviously it's a very volatile and uncertain external environment that we have to operate in around the world. And, what you search for are, when you're making investment decisions, there are costs of capital that are impacted based on your risks in particular geographies. And certainly a risk that we continue to evaluate when making investment decisions is tax risk. And tax risk, again, isn't necessarily about are tax rates going to go up? It also centers around how stable is the system and how is the tax law implemented? Okay, what's the administration around it? Can we establish a transparent relationship with the tax administrator so we can gain trust and minimize controversy? And those things are critically important. And sometimes you pay more for that level of certainty and predictability. And so I think for us, it's, anytime, temporary is one thing. If we know it's temporary, but we know what it is after that, that's a different dynamic than what's the world today. And do I trust this is going to be the case in 5 years, in 10 years, or what are the risks with that? I mean, there are certain countries in the world, which I won't necessarily name, that there's going to be no stability, there's going to be no predictability, and all things equal, that becomes less attractive than another geography where you have that. So I would hope that no matter what happens post the election, from a tax reform perspective, that it can be done at a minimum on a bipartisan basis, so that at least we can have something and have the framework we know that largely we will be operating in, at least on a midterm basis. Okay. I'm not one to be naive to say, can we have something that is going to last 10, 15, 20 years, because the world changes and the needs changes and the politics change. But I mean, so something that we I think a 10-year horizon with some level of predictability, I think makes the U.S. an even more attractive place to invest than it already was. I mean, I think about our business. I mean, we have a management team that's measured after tax. Okay. And so, I can tell you that the U.S. became a much more attractive place to spend brand equity dollars than other parts of the world post tax reform, because all things equal, you're getting a better return. And by the way, you're getting it in dollars. Okay. You're not having to deal with what do I think is going to happen to foreign exchange rates, for example. So there's a lot going if you're a U.S. multinational and looking to places to invest to have a competitive system. Larry brought up something, and I was a big fan of the destination-based cash flow tax. And although very complicated and very difficult to understand, and particularly unless you're in the details of it, it's hard to think that eventually we may end up looking at something like that, given revenue needs and given probably the need for other revenue sources, or just different ways of thinking about collecting taxes. And I know carbon taxation, other types of consumption taxation. The reality is current spending profile with the U.S. government is accelerating at a much faster pace than revenue collections. And so a reform of the system, new types of revenue collection are inevitable, but let's do it in a bipartisan way so that we've got some stability with whatever's done versus it's going to take 2 years to get it done. We're going to have a new tax system for 2 years, and we're going to be back in another debate in the next election. That's not helping or solving any problems with regards to, making this an attractive place to invest.
Thank you, Larry. Paul Ryan was never going to have a long political career because he was just too much of a policy wonk. I mean, he's a guy who the numbers actually meant something to him, and I was really intrigued by that in his proposal to. Because it kind of was moving us toward a bat, and there's lots of things in there that are frankly better than what we have today. So let's talk a little bit more about this consumption-based tax structure. You know, that's, I mean, we talk about it. We talk about it. Honestly, don't think anybody outside of Paul Ryan ever talked about it inside of Congress.
Yeah, well, I think the reality of what's going on and what people perceive is so different from, and for example, the whole Tax Cut and Jobs Act, or at least on the business side, kind of originated with a Democrat, Alan Auerbach, an academic who's a lifetime Democrat, as far as I know, but he was voicing things that most economists, and the fact that he and I and others got Paul Ryan's ear through the Ways and Means Committee and directly, nobody on the Democratic side would know this necessarily. So this gets to the point of we want to think about fundamental things we're after. We're after equity. We're after incentives to work. We're after fiscal solvency. That's really where we should start the discussion. And Tad and Tony are both pointing out that, the way we're having the discussion, we're not kind of focused on those fundamentals, and then every side gets in and they start flipping things around and nobody has any surety of what's going to happen. So that's not great for the economy, for people making long-term plans or thinking about investing here. But the consumption taxation could just change the whole, if we moved to a different way of doing pretty much the same, to a large extent the same thing, but with a different collection mechanism, like a personal cash flow consumption tax, and assess that tax at a progressive rate structure, and said, look, we're not going to tax businesses because businesses are ultimately paying taxes on behalf of people that own it or work for them. We're going to just go right to where the real thing we care about is spending inequality. So we're going to address that directly by taxing consumption. And one way, and so this could maybe just change the whole conversation and get both sides on the same side of the table, both parties on the same side of the table, because what we're talking about here would be taxing very simply, all the money that you get in a given year, minus all the money that you invest or you save, which then is invested. That's your tax base. That's your liability. That's your consumption. Money in minus money out. That's why it's called cash flow. And so you get to, the income that you don't save is consumption. Income minus saving is consumption. And all we have to do is calculate that. And we're now, because of this electronic world we're in, we have people getting receipts electronically and investments that are, recorded electronically. So we're in a position potentially to say, okay, well, look, this person actually did a lot of consumption, and he did so much consumption, we're going to tax him at a higher rate than this other person who's poor, who didn't do much consumption. So I do think that we have to start kind of focus on these three or four fundamentals, start thinking out of the box. Now, whether the Democrats would actually be able to do that, I don't know. Whether they have enough intellectual firepower. Bill Bradley, used to be one of the key guys in the Senate Finance Committee who was talking about this stuff, but it's a long time since Bill was there. So I don't know. I'm hopeful that we can have an intelligent conversation and lower the, if Biden's elected, and lower the vitriol, and just really talk about what we're after fundamentally. And, I would say that most people would say, well, consumption taxation is regressive. And we know, you guys know that, and I know that we can do consumption taxation 3 or 4 different ways. But if you say, yeah, it is regressive, but at least from some angles, it's also progressive from this angle, even with flat rates, but with progressive rates, it's certainly not regressive. So now you got the Democrats may be interested. Anyway, so I'm just trying to blend everything together here, that we need to look at fundamentals, change the conversation, collect revenues a different way, and maybe that will be something that will stick permanently.
No, that's a great point, because when we think of tax policy, when we think of regressive, the sales tax comes to mind. And we just assume that's the only way that you can have a tax on transactions and the only way that you can have a tax on expenditures. And it's not. There's multiple ways of doing this. It's just the way that we happen to do it. So Tony, where do you think your clients are going to this? Yeah. Okay. How do you ask it? How do you answer a question where you don't know what the election is going to be? So what are your clients going to do regardless of what the election is?
I think my clients are no different than everybody else in America at this point, where everyone is just saying, you know what, let's just make it 10 more days. Let's see what happens on November 3rd, because everyone is just so interested in this election, from a more global perspective than even just the tax aspects. And, certainly my clients, as far as accepting what may become their reality, I certainly talking to a lot more on a frequent basis about preparing for a blue wave, right? And so I've done more calls with clients in the last 2 weeks about, the impact of the change to capital gains rates or the phase out of 199A deduction that Biden is proposing, or maybe more importantly, changes to the estate tax than I had done in the previous 2 months, because clients are reading the same articles that we read as far as the likelihood of both a Biden victory and Democrats taking back control of the Senate. And so they're certainly starting to prepare, but I think at this point we are so close that everyone's just kind of really curious to see not just what happens on November 3rd, but if November 3rd is really the end of the story, if we know on November 3rd, or when we may know what comes next. But the interesting thing that maybe we should talk about a little bit as a group is a lot of clients want to talk about what's next for tax reform, as far as just have me explain the changes to them. But more importantly, the question everybody's been asking me is, okay, if a blue wave does indeed happen, when does tax reform happen? When does Joe Biden put all these policies into place, particularly in the context of the fact that we are in the midst still of a global pandemic and cases are rising, and we've ended up in such a strange place where we cut taxes in 2017, 1.5 trillion when the economy was thriving. And then, I don't know, Larry's opinion on it, or whether that was good or bad policy, or whether you should be raising taxes when the economy is strong. But we cut taxes when the economy is strong, and now we may be looking at raising taxes when we're in the midst of a recession and a global pandemic. And I would love to hear, from the other two gentlemen about what their thoughts are of not just what the timing will be, but what it should be, right? In terms of, if Biden can go in and do exactly what Trump did in 2018 and repaint the tax law however he sees fit, the question is, when should it happen, based on what the next year potentially looks like as we continue to deal with COVID?
What do you think, Ted?
Well, it took President Trump close to a year to get it done, right? And that was with a Republican House and Senate. It's complicated, right? And I think it's a question of how much reform is involved. All right, if it's nothing more than raising the corporate rate, I would think that could actually get done pretty quickly if he's got a Democratic House and Senate. If it's so it all depends on, to Tony's point, I think we'll know a lot more. Maybe not next Tuesday, but certainly after that, I think will be more informative in terms of how this could play out. But it also depends on the magnitude of what they try to take on versus, in the short term versus the long term. I think, for us, we specifically are modeling out many different versions of what reform could look like at the corporate level. At the same time, U.S. tax reform is going on. There's a very large policy debate happening on a global basis with regards to allocation of profits for tax purposes of multinationals that could further influence how the U.S. thinks about tax reform, okay, and how they might, along with discussing the rate, how they think about the incentives we have for exports and owning intellectual property in the United States, or the minimum tax regime on foreign earnings. And so obviously the more that's tackled, and does individual reform become part of the initial reform, which can really complicate things. So I think it'll depend on how much they try to tackle as to how quickly it can go, and how much what's going on internationally influences how how they think about even the corporate side.
Larry,
But I would
anything-
expect if anything
Sorry.
happens, it's probably in 12 to 18 months.
Okay, interesting.
So Scott, you want to talk about how do I see if Biden's elected, how do I see the economy performing? Is that the main?
Actually, that isn't what I was going to ask, but that's a lot better than what I was going to ask.
Well, I think that certainly some people are going to be, scared off by corporate, he's not taking the corporate rate back to where it was. We have expensing for equipment. So in the context of raising, I don't see that what he's proposing is going to, in of itself, be really dangerous for the economy. He's going to bring stability. We've got a guy who's pretty unstable when it comes to foreign trade and starting trade wars and dealing with our allies and inviting, we don't really know what's up with this guy in Russia, whether how he would react if Russia moved in to take over more of Ukraine or all of Ukraine would be in a shooting war. What's going to happen in the South China Sea? We need to have, I think, somebody who's a little more adult will calm things down and bring some unity to the country and to the world. We can't be, I think we don't want to be isolated in terms of international trade, and we're kind of in a situation now where China and Asia in general, because they've handled the pandemic so well, may be able to form trade deals with EU and with the UK without us at all. And South America, Chile's gone from our being their major export partner to China being the biggest export trade partner. So I think, if the market really feared Biden, it would be far below where it's valued today. I think in general he's likely to make things as opposed to be a threat for the economy.
Okay, thank you. Yeah, we had a vacation in Chile last fall, and Americans were the minority in the Santiago airport. The rest of the world was the majority in the Santiago airport. So, John, do we have any questions from the audience?
Hold on for a second. Let me check and see here. It looks like in the Q&A, no, and also in the chat, nothing really. Everyone's been just answering the poll questions. So if anybody does have a question, please jump into either the Q&A or the chat and ask that, so then I can get that on to the group. But until then, do you guys have questions for each other? Do you have?
Yeah, Tad.
Besides Tony, you're out.
So Tad, tell me.
I got all of them.
Tad, are you losing sleep over Brexit? Or don't you care?
I've lost a lot of sleep over Brexit. But look, as a business, we're prepared for, the different scenarios that could play out. But going a little bit to Larry's point, we haven't really talked global trade, and that's obviously, that there's a lot to be gained by having effective trade relationships with our trading partners around the world. And whether that's between the EU and the UK, or the US and China, or China and Europe, these are all very important relationships that need to work. And again, we don't need more barriers put up to free trade. So it's obviously an important issue. I don't know that I'm, optimistic or pessimistic. I know what's going to happen. I'm not even sure I know what I want to happen, but I do know I want the UK and the EU to have an effective relationship, and trade's obviously a big pillar of that. And I think they'll eventually get there. They're important for each other. But yeah, no, we've had to do a lot of planning, both on the Treasury side as well as the business side to plan. There's a lot of import and exports going between Europe and the UK in our supply chains.
Scott, I had a question for Larry, if I could.
Yeah, please do.
I've always been curious on, to hear an economist's view of the presence, like, assuming we have, we keep the system that we have, we're not going to move to, a destination-based cash flow tax anytime soon, but the presence of the interest deduction, right? And your view on its role in the tax law. And, I know that they've talked for years about fully eliminating the interest deduction. And obviously we took a half measure with that in the Tax Cuts and Jobs Act with new 163J, limiting it to 30% of adjusted taxable income, even though that's already been kicked up to 50 because of the pandemic. But whether you think the interest deduction should go, whether it needs to go, if 100% expensing were, say, made permanent and extended to structures, otherwise you kind of create negative tax rates, right, with 100% expensing and interest expense. But I've just, like I said, I've always been fascinated to hear an economist explain their view on the interest deduction, whether it's good or bad to favor, debt over equity, and just kind of your thoughts in general about whether it belongs in our code.
Yeah, I think it does not belong in the code I don't think businesses should be allowed to deduct interest on their loans, especially in the context, as you were saying, Tony, of being able to expense their investment, because you want to have, you basically don't want to have the government interfere one way or the other in investment decisions. And by having 100% expensing, no interest deductions, you're saying on all investments, 100% expensing, you're saying that, gee, if you invest in this particular, in our country, in this bit of, in a certain way, well, you're going to get an upfront deduction at a given tax rate, and you're going to pay taxes through time at that same tax rate. And this gets to the point of stability of that tax rate. If you've got an upfront investment, a deduction at a low tax rate, and then in the future the tax rates were higher, you perceive that you're going to face taxation on that investment. But otherwise, if the tax rate, we're going to have a stable system, the tax rate stays fixed, if we're going to keep with a corporate tax with 100% expensing, then somebody says, well, look, I'm getting upfront what I have to pay back in the future. There's no actual taxes in my investing here in this country. Let me do it. And that's what economists like. They like to have the tax policy not be able to generate revenue, but also not influence decisions, not force people to, if you put somebody if I put Scott in a 99% marginal tax bracket, I'm sure you'd retire tomorrow. Even though I know you like your job a lot, but we have a lot of poor. If you look at the 20% of the population that's poorest, they're facing, a quarter of them are in a marginal tax bracket of 25% or 70% or higher. And a lot of people there just don't work, or they work in the, in the underground economy, or they get into other activities that aren't, considered, not part of the formal sector. So we do have, we need to worry about incentives, and that's the big thing economists focus on. So yeah, with the corporate tax, definitely don't want to have a combination of interest deductibility and investment and expensing, but also, at the individual level, you don't want to have sky high marginal tax rates on anybody. And right now, even forgetting, the super rich, the poor, you look at the broad middle class, you add together all the different marginal taxes. And if you go to Kotlikoff.net, there's an article I wrote about marginal taxation with some co-authors that has a comprehensive picture of the marginal taxation right now of Americans. You'll see that, that we have almost everybody at the medium, independent of income, the median marginal tax rate is around 45%. So that's a pretty high place to be. It'd be much better to be down around 30%. So comprehensive reform, there's another thing somebody could read at Kotlikoff.net, which is a book which is a free download called You're Hired, not You're Fired, but You're Hired. And it lays out a reform plan for taxes, which would get, and also the benefit programs, so get everybody at the same 30% marginal tax rate. That's you know, if we had that, that's kind of the intelligent conversation, progressivity, good incentives. And if you talk more about these fundamentals, we can get away from the politics so much, you know, because we'll be talking in ways that Mitch McConnell will have to connect to, and AOC will have to connect to, and they'll have to talk about fundamentals, fairness, incentives, fiscal solvency, and carbon taxation, and the environment. Yeah.
Well, John, what do you think?
Yeah, I think
we're a minute over.
made it. That was a lot of information in a short amount of time and covered a lot of bases. So so thank each of you for being a part of the conference, and really appreciate it. So virtual round of applause for Scott hosting as a moderator, but Tad and Tony and Laurence, thank you guys so much for being a part of this. Yeah, that was cool. And I'm not even a tax person, so I followed along. So thank you. I had to Google a couple of big words, but we were good. So so thank you guys. I appreciate it.